David Burrows is here from Barometer. We're talking today about North American large caps with Elizabeth in Peterborough, Ontario. Good evening, Elizabeth.
Good evening, gentlemen. Thank you for helping me in finding out whether I'm doing the right thing. I have Bank of America, and it is such a boring company at the moment. And I'm wondering, is it in a holding phase, like accumulation, and should I keep it, or should I get rid of it? Thank you for your advice.
You've said before, boring is good.
Yeah, no, I have to say that Bank of America is in the right group. Yes, it's been consolidating. This has been consolidates, it rallies, it consolidates, it rallies. I think that what you want to own this for is over the next 3 years, you're going to probably see some very good dividend growth. You're going to see them take some market share. I think the most recent quarter was held back, like many of the banks, because as rates moved higher, refinancings of mortgages went down, and that was a drag on the earnings of some of these companies. I think that interest rates are normalizing in here, so I think that you're going to see the mortgage refinancing pick back up again, housing probably pick back up again a little bit. And Bank of America, I think, has a wonderful franchise that they can probably build on as they move forward.
And by some metrics, cheap. It's trading about 32% of a discount to its price to book.
It is, and you have to remember that the U.S. banks have been held back in their ability to pay out dividends by the Fed as they've been rebuilding their capital. Many of the biggest banks have done that. The dividend payouts in general are extremely low relative to their historical norm. So as they are allowed to start raising dividends, as their capital is rebuilt, you should expect probably much faster dividend growth out of the U.S. banks than the Canadian banks going forward, and they're much cheaper.
All right. Thank you very much, Elizabeth, for joining us from Peterborough, Ontario. Woodbridge now for Pamela. Hi, Pamela.
Evening. I am interested in 3M. I'm interested in your opinion on the company as a whole, and where do you see it in 12 months out, and what would be a good entry point? I would like to hold it 3 to 5 years. Thanks very much.
Thank you.
So on 3M, let's talk sector first. The industrial sector probably right now is the best performing sector in the market. 3M fits, right in there. We own several companies in the industrial space, including United Technologies, GE, which had a wonderful day today. 3M is slowly working its way higher. It's a broad-based geographic exposure. U.S. is only about 35% of the business. They've got a very diversified base of products. I think that this is something that you could own and get good dividend growth from. It's about a 2% dividend. It will benefit as things get a little better. Europe is a little further back in the recovery than the U.S. is, and that is starting to come on. We're seeing that in the auto industry. Certainly, the European auto companies are doing well. Magna reported better numbers in their European businesses. So I think that this is something that you could own here, and I would buy it at these prices. If you could buy it on a pullback to 122 or 121, great. It's just I don't see near-term pullbacks.
Yeah, the sentiment on the street is that Minnesota mining and manufacturing a year out will be pretty much where it is already.
Yeah, I think that what you should be expecting right now is, in general, earnings are getting a little better, but we're in a market where price-earnings multiples are expanding as people get comfortable with the fact that rates are going to stay lower longer. So I think you could get some price-earnings multiple expansion. You get some earnings growth probably in the 12-13% range over the next year. And if the economy keeps getting a little bit better, you should see the estimates move a little higher.
Thank you, Pamela, for the call from Woodbridge, Ontario. We're just getting this moving across the screen right now. Bloomberg Business News is reporting Twitter, and I'm apprehensive about this. Twitter said to price IPO, so we don't have this as formal confirmation. They are quoting an unnamed source at this point. Twitter said to price the IPO at $26 per share. We didn't see his eyebrows there go up. Why?
Well, it's right at the top end of the range.
It's about $1 above the top end of the range.
This is, it's interesting when you look at how the progression of the range has gone from the mid to high teens to high 20s. It tells you about the demand for this. Now, I'm mixed on this, partly because the social media companies have really been very strong leadership in the market. They have been a little bit sloppy over the last few weeks, I think, in preparation for this deal. People have been maybe freeing up a little bit of capital. This is going to be a tough one. We're in to buy some stock in the deal. I think that this is it's a sector that we want to participate in, but I have to say I am disappointed where it's being priced.
Now, again, this is Twitter said to price the IPO at $26. This is coming from Business Insider, according to Bloomberg here. The commentary that we've been hearing in the lead up to this was that, by and large, we tend to underestimate both the revenue and the earnings power of these companies. You know,
Yes.
Facebook by 13% on revenue, 26% on the bottom line. LinkedIn, it was even greater. So are we seeing unbridled enthusiasm for something that is a bubble-ish sort of play, or is it that really it is worth at least $26 a share?
Well, I would say this. First of all, I think absolutely on these deals, the analysts are very careful about what they say, and they tend to underestimate the opportunity. You know, Twitter really does have an absolutely dominant position in the marketplace. And the opportunity for them to generate revenue from the subscriber base that they have ultimately is going to be substantial. So I think that you have to start, in any investment we make, we start with a small position, and to the extent that it starts to work, we'll look to add to it. We identify a price below the price we're entering at, where we'll go to the sidelines if it doesn't work, and we'll get stopped out on a lot of positions. But we'll start with a piece. And very often we find the strongest performing companies are the ones that look at most expensive. Just turns out people are not optimistic enough in their estimates. So we'll see going forward. But this is a strong group. There's a big opportunity, and we think we should participate in it.
All right, again, Business Insider is reporting that Twitter IPO has been priced $1 above the high end of the expected range of $23 to $25 at $26 per share. It'll begin trading tomorrow on the New York Stock Exchange, not the NASDAQ, under the ticker symbol TWTR. We're going to take a brief break. We've got David Burrows here from Barometer taking your questions on North American large caps. You can't stay with us. We repeat the program at 12 a.m. Eastern, 9 p.m. Pacific.